Welcome back to Yahoo Finance Live. Fed Chair Jerome Powell is talking tougher on fighting inflation, and there's good chance that upsets many different asset markets in the weeks and months ahead. Let's dive into all things markets with Truist Co-Chief Investment Officer Keith Lerner. Keith, good to see you as always. So Jerome Powell, it looks like he wants to rebuild his inflation-fighting credentials. Should investors be terrified?
Well, first, Brian, great to see you. Great to see you all back in studio as well. As far as with your question, I don't think investors should be terrified, but I do think that, after being big bulls the last 2 years, we think the risk reward for the market now is more balanced. And one of the reasons why we're a tinge less bullish than we had been is because the Fed is behind the curve and they have to play catch up. I mean, where they're starting from as far as raising rates is, inflation is much higher than average when they begin to raise rates, and the unemployment rate is much lower than average. So I think there's a big task ahead of them, Brian, in order to bring down this inflation at the same time not overly hurting the economy.
Keith, it's Julie here. At the same time, the market knows that the Fed is going to do this. Stocks did sell off yesterday. You could argue they didn't sell off by that much, and we're not seeing much movement this morning. So I guess my question is, when is this rollover in a more decided fashion going to happen?
Yeah, our perspective is we're not looking for a big rollover. We're looking for a continued big, choppy range. Another way to say that is no new highs, no new lows. And we have more underneath the surface. What you're seeing is more of a defensive market. The other thing, Julie, that I think is important is, one of the shifts in our recent view is because we've seen interest rates move up so quickly. And when we look at the comparative valuations of stocks relative to earnings, one of the quantitative models we look at now suggests that stocks should still outperform on a 12-month basis, but at a much lower pace. So the margin of safety that you have in stocks is somewhat less than it had been historically.
Keith, the way things are shaping up now, you have Jerome Powell shaping up to be a bull market killer. I look at these rate hikes that could be coming down the pike. At the same time, we could continue to get double-digit reads on inflation. It can't be good for many areas of the market. It just can't be priced in.
Yeah, well, listen, the market has aggressively priced in a lot of rate hikes. There is actually a positive scenario, Brian. Inflation is likely at least probably peaking at these levels. The question for Wall Street is how quickly those inflation levels come down and at what level will it settle out. So there could be a scenario, and I think what the market's somewhat concerned about or will be concerned about, they could actually be raising rates into a slower economy and inflation coming down somewhat in the second half. But, if you look back to 1994, which is an example a lot of people like to bring up, that was a soft landing. That's a hard landing to stick. But it was a big choppy range for the overall market. I heard some of your conversation earlier, Brian. We still think recession risk, at least near term, is relatively low. We just think we're having more of a slowdown. And, earnings this so far, I think, are still being somewhat resilient. So there's some offsets. The last thing, as you mentioned, sentiment. Sentiment is, pretty gloomy. And from a contrarian perspective, that's a positive. So, again, it's a bit of a tug of war that we expect to continue over the next several months.
And those reasons that you just outlined are a couple of the reasons why you say in your note, you're at pains to say you didn't go underweight because there are still some things perhaps underpinning the market here. And you just mentioned a couple of them, earnings and the fact that we're not going to get a recession anytime soon, in your view. How do you trade all of this? If it is a choppy range, what do you do?
Mm-hmm. Well, the first thing, and we've been doing this really since February, even before, the invasion and before the Fed even got more aggressive, we were saying to our clients, expect much more moderate returns, much higher volatility and the frequency of volatility as the Fed transitions. So what we've also done this year is we've brought in our bets, right? We brought in our equity exposure somewhat. Our sector exposure is much more defensive and commodity linked. So we like things like staples. We just upgraded healthcare yesterday. REITs we continue to like, which are more on the defensive side. We've been long bulls on energy over the last year. Maybe that has to consolidate a little bit. So there's still relative opportunity. And then within the S&P itself, we like the equal-weighted S&P more, which isn't so cap heavy. And then lastly, I'll just say more globally, we still think the U.S. is in the best relative position. I did say last one, Julie, but one other thing to mention is with the yields moving up, yields are productive again. So we actually have increased, even though we're still underweight, our fixed income side of our portfolios.
Is it time Keith, is it time to start nibbling at tech stocks? Anywhere you look, really, in the NASDAQ. I think One good stat I heard this week, 50% of the NASDAQ has seen 50% or more declines. Is it time to wait in there?
Brian, we would still wait. We are underweight technology. The narrative makes sense that tech should start to do better if you see an economy slowing down. But we're not seeing it in the price action. We're seeing semiconductors break down on a regular basis. We're seeing the overall sector at a multi-month relative low. So we would prefer to see some stabilization and be a little bit late on the turn than trying the bottom pick, because bottom picking has not worked for that sector over the last several months.
Keith, what would you need to see to upgrade your view on stocks?
Well, I think a couple of things. I think, one healthy thing is just to continue kind of chop. We let earnings continue to move higher, valuations continue to compress. And then I think one of the more important things is the market and investors to have a gaze that this is where the Fed is going to stop, or this is where those Fed rate increases start to move over. I think the challenge for the market right now is, every week, what's embedded in the market continues to go up from the Fed and inflation. So once the market has greater confidence in a peak in inflation and where the Fed is going to ultimately peak as far as the Fed fund rates, I think that would allow the market to move higher. I just don't think we're going to know that over the next few weeks and even maybe the next few months. And that's why we're looking for more of a choppy, continued market, Brian.
And finally, Keith, we talked a little bit about this, but the flip side of you downgrading equities by a little is you're upgrading fixed income by a little. So what does that mean exactly? Should people be going out and buying fixed income at this point? Where on the curve and what size, I guess, should people be looking at this?
Sure. And, if you think back, the 10-year Treasury yield in 2020 was down to 0.5%. And we were very negative, had our lowest allocation in fixed income over the last decade. Now the yields have moved closer to 3%. And a lot of that just happened recently. We would be increasing high quality fixed income, but we're seeing some relative opportunity on the short end of the curve, say, 2 to 5 years, where you're getting almost the same type of yield that you're getting at the 10-year with a lot less interest rate sensitivity. So we like that, and there's some opportunities on the credit side as well.